Modern post-secondary beauty education is rarely a glamorous pursuit. Instead, it operates as a rigid, high-stakes financial system. A typical student faces program costs exceeding $16,000, requiring $7,100 in federal loans, $600 higher than the average for other certificate programs. After graduation, the math fractures. Median earnings sit at merely $16,600. By comparison, restaurant cooks yield equivalent starting wages with zero educational debt. Even a 2-year associate's degree in liberal studies frequently costs less to acquire, while producing significantly higher median earnings. Taking on high-interest, non-dischargeable federal debt for localized, manual skill vocational training creates a structural trap for lower-income students before they ever enter the workforce. It is easy to blame this crisis on poor student financial literacy or isolated fly-by-night scam schools, but the actual cause is the federal regulatory framework that oversees these institutions. Access to federal student aid is controlled by the regulatory triad: the Federal Department of Education, state licensing boards, and private accrediting agencies. Congress established this 3-part gatekeeping system in the mid-20th century as a risk management tool to ensure educational quality and protect the federal treasury from waste. This structure mandates that schools adopt high-overhead academic models to access funding, a requirement that ties tuition prices to federal compliance rather than educational necessity. The current debt levels are a predictable outcome of a federal policy architecture that prioritizes institutional bureaucracy over affordable vocational pathways. Tying federal funds to private accreditation began as a mechanism to prevent fraud following the 1944 GI Bill, when the government lacked the capacity to evaluate thousands of new vocational programs. This created a system of double delegation, where sovereign power moves from Congress to the Department of Education, and then laterally to private nonprofit corporations. The department delegates the gatekeeper status of billions in Title IV taxpayer dollars to private accrediting agencies like NACAC. These accrediting bodies are private membership organizations, often governed by executives and owners of the dominant beauty schools they are tasked with regulating. Because these private entities are exempt from the Administrative Procedure Act, an adverse decision that cuts off a school's federal funding lacks traditional federal due process protections. By outsourcing oversight to industry insiders, the federal government has effectively authorized a private cartel to arbitrate who gets to compete in the post-secondary market. The Department of Education tracks institutional compliance through the OP-ID number system. Federal regulations evaluate financial viability and student metrics at the OP-ID level, allowing large corporate chains to be treated as a single entity. This allows them to absorb administrative failures at individual branch locations by averaging performance across their network. A small independent beauty school operating with a single location and its own unique OP-ID possesses no such safety net. A single metric failure results in the immediate loss of Title IV eligibility, driving closure and consolidating the market. Federal tracking mechanics systematically consolidate market share toward heavily capitalized enterprises by socializing risk across corporate networks while localizing risk for small businesses. Securing and maintaining this mandatory accreditation functions as a regressive compliance tax on the institution. To stay in good standing, schools face a schedule of direct financial obligations, including annual sustaining fees, on-site evaluations costing over $4,400, and thousands more for every program change. These direct fees are secondary to the significantly higher indirect costs of remaining compliant. Maintaining accreditation requires constant administrative labor to track clock hours, document clinical sanitation, execute self-studies, and manage complex federal data systems. Large chains distribute these overhead costs centrally, but small schools must divert funds away from instructional equipment and educator salaries just to manage the paperwork. This compliance burden fundamentally alters the nature of the school, forcing lean vocational training centers to adopt the bloated overhead structures of traditional academic universities. The end result is a system where the cost of education is driven by the cost of bureaucracy. This structure triggers the Bennett hypothesis, the economic principle that increases in federal student aid are directly absorbed by institutions through tuition increases. Because students cannot use Pell Grants at her accredited schools, institutions must pursue accreditation to access low-income students. This immediately introduces the heavy administrative overhead required by private gatekeepers. To offset these compliance costs, the school must raise tuition to match or exceed the maximum available federal funding thresholds, creating a vicious cycle of debt dependency. This dynamic establishes an artificial price floor that systematically starves debt-free, localized, or low-cost workforce models of prospective students. By requiring accreditation to access Title IV funding, the government has effectively outlawed lean instructional programs that could train students for licensure without federal debt. The Department of Education's primary tool for closing failing programs is the 2023 Gainful Employment, or GE Rule. The GE Rule evaluates whether a program's graduates can afford their debt by measuring their annual loan obligations against their median annual earnings. While the math appears rigorous, it is structurally incompatible with the labor economics of the beauty industry. Standard metrics fail to reflect the commercial reality of a sector characterized by independent contracting. Professionals legally claim extensive business deductions, like chair rentals, which significantly reduce their reported adjusted gross income. Because federal databases pull from taxable net earnings rather than gross revenue, and often miss tipped income entirely, they capture only a fraction of a graduate's cash flow. Utilizing a metric that ignores these reporting anomalies triggers arbitrary program closures, particularly for the small, family-owned schools that serve as community business incubators. To restore economic mobility, the United States must pivot towards structural reforms that bypass this regulatory triad. One option is reclassifying beauty programs under the Department of Labor Registered Apprenticeship Framework. This would allow federal workforce development grants to flow directly to students and employers, prioritizing on-the-job training and entirely bypassing academic accrediting agencies. A second fix involves amending federal code to allow a CPA-audited alternate earnings appeal. This would allow schools to prove their graduates' actual earnings through independent audits, resolving the data limitations of federal tax databases. Market-based solutions also require a federal Radical Transparency Act for student disclosures. All schools should be mandated to publish a standardized plain language dashboard proving their value in total program cost, graduation rates, and median graduate debt before a student enrolls. The current system attempts to protect students by forcing localized manual skill programs into a regulatory mold designed for multi-year universities. Fiduciary stewardship of taxpayer dollars is essential, but the current metrics create a structural barrier that targets independent businesses while protecting corporate networks. By dismantling the gatekeeping power of private accreditors and adopting accurate success metrics, the U.S. can replace a cycle of debt with sustainable economic mobility.